Welcome to Credit Markets today. We have a fabulous group of people on our panel today, and you're going to get to meet them by video shortly. But I'd like to start, if we could, with Rich Byrne. And let's talk, Rich. You were in charge of finance and for a major bank in the world. And over the last few years, you've transitioned to an asset manager. What are your concerns about liquidity in the system as an asset manager today, and juxtapose your job today versus what it was at Deutsche Bank?
Sure, Mike. The liquidity in the system is a great question because when times are good, there's tons of liquidity in the system. But I think we have some slides that were provided from the Milken Institute. And by the way, if you ever need a slide, ever, on any topic in the history of man, undoubtedly the Milken Institute will have it. But dealer inventories, all-time lows, high-yield market, investment-grade market, two great examples, have never seen a greater trajectory of volume. In fact, high-yield market is double what it was pre-crisis. Dealer inventories lower. And when times are good, that all works out just fine. And when times are not good, it tends to create some pretty bad outcomes as far as heading for the doors. Sort of bonds, par bid, all of a sudden, 90 offered without, and a long-only marketplace, mutual funds, ETFs, insurance companies that have really no choice but to follow their flows. So that's troubling, and that's a result of regulation. Volcker rule is, one big one, obviously Basel and Dodd-Frank. And banks have just behaved in a different way. And then I don't know if it's sort of the purview of that question you're asking, Mike, but that has also led to a lot of disintermediation of what otherwise was businesses that the banks, you would traditionally think of. One of them is middle market lending. One of them is sort of, the real estate credit business. One of them is certainly the prop desks in the form today of hedge funds that have migrated from banks to the street. So there's some good and there's some bad.
So Rich, let's see what you look like in London last year. Let's see what your views were last year.
There was little.
Well, maybe we'll bring you up in a minute or two.
I think I look pretty good.
Mike, could I add to that?
Sure, go on, David.
I think I'm a bit of a contrarian on this view of what's happened with liquidity. It is true that banks' balance sheets are smaller, and that's a direct result of regulation. But I look at liquidity as a double-edged sword, and there's a real positive in it for investors, which is, think of this high-yield markets that somebody up here created, and it used to be a niche market, and now every investor in the world basically owns high yield. There's never been a time in history where more investors actually own the asset class, understand it, want to own it. So I think that liquidity, if we just look at it as the banks, it looks a little bit worse. If we look at it as all the market participants who are willing to support $1 trillion plus market, I think it's outstanding. And I think that you have to be very careful when you invest in these types of securities. How are you going to get out when you're done with the trade, whether you win or whether you lose? These are things that we spend a lot of time at our company thinking about, but I don't think of liquidity as being just universally negative given what's happened with bank regulation.
No, one second, we're bringing Rich back up. Is that working or not working here? I think this point on liquidity is a very important point, and there are thousands or tens of thousands of investors today. And what I was driving at, Rich, and you just might compare and contrast,
sure.
What was your day like at Deutsche Bank versus what is your day like at Providence?
Well, at the bank, I think you have to compare pre- and post-crisis life at a bank, Mike. And pre-crisis life at a bank, maybe the best answer to your question, looks very similar to what life looks like today at our shop, at Providence, Benefit Street Partners. But post-regulation, it changed a lot. I think we're going to have that video at some point.
Okay, let's go take a look. We're going to give it one more chance, Rich. Let's see you.
There was literally, I'll do this in terms of my arms. this much of a gap created by the banks leaving the market, this much of that gap has been filled by these alternative capital providers. The entire market cap of the entire BDC space is something like 40 billion. That's almost the amount of the annual amount of underwritten loans that banks participated in the middle market space. So it's getting there, but this was an unintended consequence, and hopefully as alternative capital continues to form, this will help hopefully have the positive consequence of pushing the economy along. In the meantime, it's created great businesses for firms like ours.
So one of the things you will notice at Milken Institute conferences is that we record and write down and keep track of what you say. Maynard Keynes once said, it's better to be vaguely right than definitely wrong. So we don't give you that option, and one of the good things you'll see today is our panelists consistently over the years have been definitely right. So Rich, what I was really driving at here was, when you're buying credit, could you contrast the research follow-up process? How often are you looking at that versus what you might have done at a bank?
Well, I think in bank world, banks are good at a lot of things, and they're a lot of breadth across a lot of markets. In asset management world, for example, I think I could speak for everybody on this panel, this is what we do. This is credit. We live in the credit world. One of the businesses, and it was part of the clip I think I was referencing, was direct lending, the middle market lending business. Well, this used to be a great business on banks' balance sheets, but really it was treated like any other business on a bank balance sheet. I think these were just viewed as the smaller loans within a bigger loan portfolio. Post-regulation, banks really can't be in that business anymore. Basel 2.5 at the time, Basel 3, risk-weighted capital weightings, the amount of employees it takes to underwrite these loans is the same as to do the big LBOs. So banks tend to migrate upwards to the bigger size where they can get the scale out of what they do and utilize the balance sheet. Whereas a lot of that stuff, the really cool roll up your sleeves work on credit, I think migrated and got disintermediated to managers like us and took really good businesses. And by the way, as a general rule, when a bank is not in a business, it tends to get a lot better from a supply-demand perspective, because banks tend to throw a lot of capital at a lot of businesses.
So David, before I go to you, I want to run a little video of you a year ago. Let's take a look at David Warren. Maybe.
I have a new goal in life, and that goal is to come back here to the Milken Conference 2024. And you cannot play the tape of what I'm about to say until 2024. But I really believe that the next decade is going to be the golden era for credit investors because of Dodd-Frank, because of Basel capital regs, because of pay limitations, leverage limitations. These are all leading to reduced banking sector balance sheets. Banks are going to continue to play important roles, but it's really investors who have the direct opportunity, really in some cases for the first time, to participate in origination, to participate in complex, high-return credit and lending opportunities that used to be originated by the banks, held within the banks, occasionally distributed, often just held. And I think some of the focus of firms like ours, like others that are up on the dais, are we want to locate those returns for you and manage money. And it's really going to be a great chance to do that because the world needs the capital.
So David, there used to be DW, you used to think, Dean Witter. But now that there's no Dean Witter, I noticed you've taken the firm and changed it to DW Partners. Give us a little background, and then
Sure.
I'd like you to maybe give us your views of the opportunities in credit markets.
Sure. Well, clearly, I was hoping for 10 times longer to come back with a report card on what I said last year.
We didn't guarantee.
But I'll give you the one-year report card, and I think I'll try to weave that into a story that I think is timely, and I'll talk a little bit about our company as well. But this stepping into the bank's shoes that I discussed last year, this first of 10 or 20 years, I think it's really happening. I think if you talk to managers, I've already heard it 15 times at this conference, it's really happening, and I think we're all setting up with the right staff. We're not trying to get rid of banks. Banks are going to be the best sourcers. Banks are going to be the best at structuring things, but banks won't always be able to hold the capital. So I'll give you an example. Nobody's ever heard of DW, but people have heard of another company with two initials called GE. GE was the lead lender to Radio Shack last fall. They refused to roll the line of credit. Maybe now we understand a little bit more why. And so DW, my company, stepped in and provided that loan. And it wasn't providing a loan at 250 over, it was 1,000 basis points more than that. And this is the type of high return on capital investment or trade that I think we can step into the shoes of banks and do. I think our story is really a wonderful one. We had 7 years under the wing of an absolutely world-class asset manager. I'm talking about Brevin Howard. It was a wonderful luxury not to have to worry too much about the infrastructure as we built up. In these last 7 years, think about how difficult they were. We could spend our time focusing on investing, building our investment teams. And our partnership with Brevin Howard was outstanding. It continues to be outstanding, but we've gone from 10 professionals to 55. We've gone from $1 billion of capital to $6 billion of capital. The range of activities, given some of those things I was talking about, being a dip lender to Radio Shack, doing real asset investing, you need more people, and you need credit infrastructure. So we now need to have people in New York sitting next to us who are full-time credit professionals, and that's the reason why we fully spun off and our LPs voted to make the funds DW funds.
Thank you. So, Tom, let's take a look at some of your statements over time.
The good news in the U.S. market is you do have that level of institutional appetite ready to go. You know, we have a lot of interest in those markets. In the recent backup in September, October, you know, we found a lot of examples where we were buying assets that maybe 2 months ago we thought were too rich, but traded into a zone where we were willing and had large appetite to buy.
So how did that investment work out? And Tom, what does GE's kind of divestment, not just of their finance army, but pretty much separating from financial access to capital and that GE Finance and Capital Group we've known about for more than 50 years. What does that mean to Babson?
I think a couple things, and I wouldn't put it just on the GE separation. I think as we've grown over the years, we've seen credit as an asset class, not just in the United States, and bringing institutional money into the United States, but for over 10 years we've been in Europe, in the high yield leveraged loan markets there, and really since '09 doing direct lending in Asia Pacific. Where in the U.S. between 1990 and today you saw the move from a bank market to institutional market, and the speed of that taken really a decade plus. What we really are seeing now is, I think, an acceleration of that in Europe and ultimately in Asia Pacific. So when I think about to the point of credit moving from a bank provided product to institutions, asset managers like us have to figure out the best way to deliver or to access that product. GE's announcement really is about a firm that built up a good finance company, but obviously there is a size issue at the end of the day, that regulation at work. So whether it's regulating the banks, which is making it less efficient or effective for them to lend, or the situation with the GE spinoff, it's clear that regulatory environment is having an impact today, and it will just further push institutions or provide institutions with the opportunity to access direct loan markets.
I think one of the things that Rich talked about was that partnership. The banking system plays a really important role, both money, let's talk market making, origination, et cetera. But the middle market and other areas might be shifting today. Steve, you've been extremely creative in your look at investments. You know, when the annuities were down, you saw them as a very interesting credit vehicle. Let's take a look at yourself from last year's last year's conference.
In 2008, it was a matter of just going to the party. You know, if you showed up to the party and you started, even, called in mid-08, even before Lehman, it was a good entry point to start. Now it's which party you go to. You just can't show up to the party. when you take your gross spread of 370, you take your default rate of 5% and 70% loss, you get not a lot of spread when you're in high yield. So that's a party we're not anxious to go to. Contrast that with other places in the credit market, such as leveraged loans. You are getting a better, net spread after expected loss in loans. When we look at different parts of the market like asset backs, whether it's student loans or AAAs, we think that when you take your risk, and in the case of AAA CLOs, we think it's relatively low risk, and the fact that you're getting spreads that are historically very wide, we think that's a much better party to go to. The same with student loans.
So last year you were wearing more of a reddish tie, telling us to be careful about this sector in the market. Now, today, Steve, you're wearing a green tie. So what are credit markets today? Are you going to give us a different message?
So I think I chose the wrong tie. First, to just comment on GE. One of the when I heard the announcement, it struck me as from a timing standpoint, call it 18 months to 24 months before a correction in the and certainly a material increase in defaults is not a bad time to sell a middle market portfolio. So from a timing standpoint, I think it's probably a pretty good time for them to get out of their portfolio en masse. In terms of where we are in the cycle, we continue to believe we're further through the cycle. If you turn to page 17 or slides on 17, you'll see that leverage was higher than a year ago. Acquisition financing was higher than a year ago as a percentage of financings. And what we've seen is that when you get 4 or 5 years into this, that the market expects defaults to increase from a low level, and we're seeing that as the market's anticipating the lowest part of the market is going to underperform. So what's happened, if you turn to page 18, is you'll see that from in prior years when the default rate was low and the average default rate's around 4 to 4.5%, and when it begins to increase, the most junior part of the market really underperforms. And that's what we've seen, significant underperformance. And from 1/1/14 through today, it's about 600 basis points underperformance in triple Cs. So what does that mean from an opportunity set? I'm getting to Michael's question, is we believe that you're going to see an increase, going to slide 20, of about $200 billion in terms of what we call the distressed part of the marketplace, or spreads over 1,000 basis points, going from around 50 billion to 250. And there are a couple of sectors that we would nominate as most likely to
succeed,
to be fishing in, to be looking at, and to be analyzing. And the first one would be the energy sector, and that would be on slide 21. This has been pretty well publicized, and you'll see that I've taken the energy and commodities and compared it to the telecom, media, and technology of the 90s. And you had a similar type of step function. And we think that there are a lot of subsectors in this space, some more interesting than others. So for instance, oil and gas is probably fair. Oil service, you're probably early. But you look at metals. Metals has been actually a pretty good space, and metals could be copper, could be gold. We think there's some interesting opportunities there. And then if you look at coal, where the market's totally undifferentiating between the opportunities, there was a deal, Murray Energy, which we think is a great company, very low cost structure, that we still think is called 8 points cheap. It's up 5 points, and we think was a terrific deal. One sector which hasn't gotten as much attention in the press, but we think is very vulnerable, is the technology sector. And if you turn to page 22, you'll see how, as a percentage of issuance, technology sector is doubled in terms of triple C issuance. Likewise, if you look at the leverage, it's gone from, call it the mid-5s, to over 7 times leverage. And this 7 times leverage has a lot of aggressive pro forma assumptions. And these are not the types of companies that would be displaying the type of results of Apple. These are the types of companies that often have revenue that's not growing. And so this is a couple sectors that we find interesting.
So Steve, it's interesting, there was a period of time of almost 20 years where there was only 4 industries that defaulted. If we're looking from kind of the late 50s through into the 70s. One was technology that you've highlighted. Another was retail, where they had the leverage of their leases. Yep. The third was real estate due to leverage. And the fourth were businesses that were government regulated, particularly railroads at that time. And when you look at those markets, one of the things that we stress is this concept of capital structure. You know, for some companies, $1 in debt is too much. For others, so when you talk about defaults, you've zeroed us in potentially on 4 industries here from that standpoint. Let's talk for a moment of moving through the capital structure. And I think one of the things you've done uniquely is sometimes debt is equity and sometimes it's debt.
Yes.
And I think you felt that there were some better investments in the equity of some of these companies than the debt. Could you talk about that for a moment?
Sure. You're looking even at an Ally that just announced today. There's nothing wrong with the debt, but the equity trading below book value, we think it'll have double-digit returns on its equity, strikes us as the better part of the capital structure. When you look in the beginning of a recovery, usually the debt is the better risk-adjusted part of the return. But we feel where we are now in the cycle, that there are many equities that we feel risk-adjusted are just better investments.
Thank you. So, Michael, it's good to have you here in the United States. Let's take a look at you just a few months ago.
The value obviously comes from where there's dislocation, and the massive dislocation that's happened out of the central banks, whether it's through QE or through the now forward guidance or contribute qualitative guidance, where these guys have pushed, frankly, all the assets into one situation. That for us gives an opportunity, but also there's a heck of a risk, in my view, in that the possibility of having a Minsky effect is that sooner or later the chickens will come home to roost and we'll get back to a normal market. European banks, the credit spreads are right on top of each other, whether it's a highly levered, aggressive French bank versus a bank, a UK bank that's in ownership of the government. They're right on top of each other. There's the ability to do those trades in credit, using credit derivatives. There's also the ability to play equity long short. Now, the reality is equity long short in the US became very crowded. It's not so crowded in Europe for one reason or other, and it's definitely not crowded in Latin America.
So why don't we go around the world, Michael? Let's talk about how you look at Europe, United States, Latin America, and other parts of the world as opportunities to invest today.
Okay, I mean, it is an interesting situation, and then obviously there's something which you do very, very well indeed, in that you have to look at history. I mean, we're in a situation now where post the GFC, we've gone from a situation where we're in pre-2008, the banks had probably not enough solvency and a significant amount of liquidity, probably even too much liquidity provided. We're now in a situation on the other side where we've got, given what's happened with Basel III especially in the US with the Volcker rule, whatever, you've probably got way too much solvency and nowhere near enough liquidity. So we're in a very interesting world where we are. So going forward, if I look at the US, again, those markets there are frankly able to provide very, very good returns. And again, I'm not going to start going industry by industry, but the point is that the economy is doing sensibly. Regulation is such that it's pushing issuance straight into the hands of buyers such as ourselves and institutional buyers. And if you look at Europe, and again, there I might show, if we go to slide 26, you can see what's going on there. The fact is that we've got a situation where the banks there are stepping out of the market. And you can see what going into the GFC, the banks were taking the money and they were repackaging it, and it was going into the non-financials, into the corporates. We're now in a situation where the banks are still issuing, but they're mainly issuing to take their tier 1 ratios higher, and then the corporates are issuing directly. Another form of direct lending. So again, in Europe, there is a heck of a lot going on there. Many cross currents. I mean, I don't know if we want to start talking about Greece and the export to China and wherever else. That is a massive issue there. And of course, if we then go into Asia, and it's easy to talk about Asia as one market, but it's definitely not. China opening up, big deal there. They're trying to make themselves into a reserve currency, in my view. But to have a reserve currency, you must be investable. So again, I think they're trying to open themselves up. So we've got China. You've got Japan, again, making major changes to their structure. You've got Indonesia's doing various different things with there's corporate governance issues there, but again, those things are being addressed. Australia being very much part of that area. I don't know if I've actually gone there, but unfortunately, every one of these topics we could probably spend a week on. So, but it is a very, very rich hunting place.
So are you saying if potential investors want to come and visit you, you'll spend a week with them? Is that what you're saying?
Well, some of them do. I mean, the world is that we are in a bespoke alpha world in terms of what are we going to look like down the road. I mean, yes, we've got certain funds which is basically line up and buy them, and they're very good, but they're unlevered, long-only funds with certain issues. The other, frankly, growth part of our business is what I would call bespoke alpha, where again we work with people who look at their risk budget and go from either being very, very highly aggressive parts of the portfolio where we can actually use their risk budget and deploy it transparently to something where it looks like a 5% return where people are very happy.
Let's take a look at a point. If we could pull up slide 51 and just look at a point that you were making. And the world has changed considerably here today. When we look at the assets of the 4 largest banks by country, well, you can see the U.S. is only at 60% here versus Switzerland and France. But these really strong financial markets we're in today allows these countries' banks to liquefy themselves today. So instead of selling securities at 70 cents on the dollar, today they can sell them at 100 cents on the dollar. And as we look at the world today, an area I want to talk about, and you see this enormous increase in corporate liquidity. If we pulled up, for example, slide 39 as an example, you'll just see the enormous growth that's occurred here, increase in corporate balance sheets. Japan, 42% of the GDP is sitting in cash on the 100 largest companies, up from 17. China, 37 up to 6. UK. In other words, there is enormous cash balances we read about, but the companies themselves have become major in the sense of their liquidity today versus the size of the country. And it's not just a doubling of, say, percentage of assets by middle class in America in cash, but it's also companies. So let's go down the line, Rich, and tell me, in this environment, in credit today, if Providence wanted to dictate terms on covenants, etc., could you do that on a new issue?
Could you do that on a new issue?
Yes, today. What power does Providence have?
No, when you go through 5 or 6 years of a virtual zero interest rate environment, there tends to be, pretty simply put, a lot of buyers and not a lot of sellers.
So you don't.
Who gets the leverage in that case? It's not the buyers.
Okay, so we want to show you here, maybe we have half a trillion up here. We want to show you their power right now in covenants. Tom, what about you? When you tell them they have to change their covenant on an issue, you won't buy it, what happens?
Well, if there's oversubscribed, you don't buy it.
And how many times are they oversubscribed today?
And probably 9 times out of 10.
Okay, fine.
And
Mike?
Yeah, no, I mean, Tom's right, but I mean, that's exactly the reason why you want to go slightly away from the crowd. And and you can play maturities, you can play various things. You know,
So,
Steve?
so we changed covenants on 2 deals this year, Citco and Murray. Citco's up, I don't know, 12, 13 points. Murray's up 5, and I think it'll be up 15 when all is said and done.
And that's out of how many?
We probably, it's been a small percentage, but actually it's still worth the time to try, and particularly on more complicated deals. In the case of Citco, Venezuela owns Citco. It's their U.S. refining operation. They needed the money badly. They didn't want to provide 100% equity interest to the debt. They wanted to provide only a 50% equity interest in a convoluted structure, and we and another buyer said no, and they finally capitulated, and it, I think, really has contributed to trading very well because the value was always there.
And you would still go, I'm assuming, then in 90% of the cases.
Oh yeah, yeah. But the point is, there's still things to do, and to don't give up hope.
David?
Yeah, what I would say is what we've talked about for the last half hour is almost exclusively corporate credit. And in these large syndicated deals, we only have so much ability to change things. We're about to close on a couple of property loans where actually we can dictate terms. And these are transitional properties. These are short tenor loans of 1 year, 18 months, where we absolutely can dictate terms. And it's a matter of urgency on the part of the borrower. It's a matter of a little bit of complexity. And that's what we're actually charging for instead of charging for risk. So
David, let's pick up on where you are today. As you look at the opportunities in credit today, I think what you've told the audience is, in the vanilla offering for corporates, most of them coming down that don't have any complications, they don't have Venezuela as a partner, it's very difficult. So why don't you identify 3 key areas that you're focused on to deploy capital?
Well, I wanted to talk for a few minutes about legacy commercial MBS because they're very important components of both of our funds. And we're positive on U.S. employment. We're positive on commercial real estate fundamentals. But if we could pull up slide 4 for a second. There's a busy slide here. There's a lot going on. But if you just focus on the blue bars, this was commercial mortgage-backed securities issuance picking up dramatically into that 05, 06, 07 leveraging cycle, and you can see crashing down since. Now, a lot of us, if you went back and showed video of me at this conference 3 or 4 years ago, we would have been talking about the corporate wall of maturities that was supposed to be huge last year and this year. Nobody's showing slides of corporate walls of maturities anymore because they don't exist and they've been stretched out. There is no corporate wall of maturities. There still is a huge commercial real estate wall of maturities. So if you turn to slide 8, this is how that issuance, and most of it was 10-year loans done in 05, 06, and 07. The orange shows what's remaining. So $45 billion of additional maturities this year, $104 billion next year, and $113 billion in 2017. Now, what's happened is a few years ago, it looked impossible, except commercial real estate conduit lending has come racing back. So if you flip one slide forward to number 9, you can see an absolute explosion, and CMBS, are we on 2.0 or 3.0, whatever we're on, it's come roaring back. So that $114 billion actually compares almost identically to the $113 billion of 2017 maturities. We're actually a bit negative on some of this new underwriting. Underwriting is getting aggressive. Some of the borrowers are getting 4 and 4.5% yields. This is a little bit scary. So we're not participating in new issue subordinated bonds. We think that's a distressed market we'll be playing in a few years forward. But what we're playing in is these legacy mezzanine MBS you can buy at 50 and 60 cents on the dollar. And then if these borrowers get these loans, these aggressive loans, we're not expecting par, but we're expecting 80, 85, 75 cents back on the dollar. It's a very attractive return in expectation.
We actually see it exactly the same way. In terms of the legacy, in some cases, they are amortized down. It's a stable portfolio, and it's issued at a similar yield with better convexity to what the new issue is. To us, the value equation, whether it's on CLOs, manufactured housing, student loans, the theme has been a really good theme. And if you turn on page or on slide 23, you'll see how many eyes have been taken off this sector. Before there was a multiple. This is the ratio of structured finance to investment and high-grade issuance. So there was more structured finance issuance by a ratio of 1.8 times in 2005. Now it's running at around 0.2. So this legacy, there are just a lot of fewer eyes on the legacy positions, and as a result, we think it broadly trades very cheap.
It is interesting, David and Steve, that if you go back to those 2005 issuance of CMBS, they were issued at 1% to 1.25% over governments. Today, even though the terms might be aggressive, they're being issued at probably closer to 300 over governments. So even though the market has come back, with governments today under 2 versus 4.5 then, the rates are pretty much the same. And so one of the questions will be, whatever credit risk that's been entered, is the additional spread going to offset? We'll have a different experience. Tom, what are you focused on in terms of credit today? Where are you looking for the opportunities for best rates of return?
Well, if we go to slide 14, when we step back from a few years ago, one of the things we did is we really focused on the fact that credit isn't just going between bonds and loans in the US and bonds and loans in Europe, and we started getting to Asia Pacific and buying direct lending there. It's really, as we think of the next 5 or 10 years, it's bringing to investors the ability to move to different markets. We can always argue at different times certain credit markets are overheated, certain credit markets are yielding better, and clearly we started looking at it as a global credit market. So in slide 14 is a good example of not only looking at globally, but also as you move from the broadly syndicated markets into middle markets, into smaller companies with less than 50 million of EBITDA. So if you really step back and think about what it means with the banks pulling away, whether by choice or by force, the opportunity for institutional investors is really, it's in the US, it's in Europe, and you go into an emerging credit market like broad Asia Pacific, which is many markets, to be honest, but in general, there today, for instance, we can see relative risk return with, say, 100 basis points more spread based on the risk return of the company versus, say, in the US. Now, we're not saying we're going to put all our money into Asia Pacific credit. The market's not big enough. But over a portfolio of credit, if you think as an institutional investor and you're allocating credit, having the ability to move globally, and then also the opportunities as asset managers go more into the middle market in places like Europe to move into private credit. It's less liquid, but if you have, and so you certainly can't do that if you need that liquidity, but there is a premium when you move down markets, smaller, less liquid credit, and across markets, there's often a good premium.
I think, Tom, you've underlined, to paraphrase you here, that when you hear a person is a credit manager, what you've heard here is a wide diversity of things they're investing in. And that spread you put up here is you're looking for additional rates of return. Steve sought that out in a Citgo security that was complicated because of Venezuela ownership, and then worked on putting covenants in that might be useful. David talked here about the opportunity to buy relative value and mezzanine and other parts of older CMBS structures. And I think what Tom has looked at is this spectrum here of credit. So all credit managers, all credit portfolios are not the same. Some might just be holding bank loans, some might be holding different structure of public debt. And so what are the covenants? And this is the difference between actively managed credit managers that we have on the panel and someone that might be just buying an index today. What is your strategy, Rich? If I asked you to talk about Provident's credit strategy looking forward in light of the level of interest rates we have and the ability to put covenants in, et cetera, how do you see Providence today, and what will Providence in the credit business look like in the next 3 to 5 years?
Well, Mike, I'll focus on a handful of places where we spend our time and maybe start the discussion with where do we not see the opportunity, or simply put, it's where everybody thinks a credit manager does, it's just long only. And that's not the opportunity. I mean, the average yield in the US is high 5s, the average in Europe is mid 3s. I mean, it was mentioned in a previous panel, price to perfection, it's always been an equity term, but in credit, there is so many things that can go wrong. You don't even have enough coupon to protect you anymore against these big, horrible events that could occur. We talked about liquidity drying, bonds tend to gap in 10-point increments, so it's not as a long-only investor. So how do you stack the deck in your favor and look at other opportunities? We talked about middle market lending. We have a good slide number 2. And why is middle market lending a good opportunity? Well, small companies present some great risk-reward opportunities, but it's really about technicals. Pre-crisis, this stat here starts in 2002, 69% of middle market loans was just what you'd think it is. It's a bank business. Banks lend money to small companies. Today, as most recently measured, first half of 14, it's 12%. That's a $50 billion annual gap. And if you look on the right side of the page, the maturity wall, I mean, there actually is a maturity wall. So it's literally the opposite of what you have in the big liquid market. Lots of demand, a little bit of supply. In the liquid market, here's lots of supply, little bit of demand, creates a different balance. And one of the places that manifests itself, to continue the discussion we were having, is covenants. So I always kid that I think the word covenant-lite was invented by some marketing firm, because really, covenant-lite means no covenants. And 2/3 of the bank loan market is no covenants. And as a result, what do you have as a lender? We seem to have selective amnesia of what it's like when the default cycle comes. I agree 100% with Steve's comment about where we're headed. And without covenants, you literally don't have anything. So specifically when you're in the illiquid asset classes like direct lending, if you don't have covenants, you don't have anything. And it gives us the ability to create bespoke covenants. A second opportunity, we showed the slide, it's one we use, as page 4, is commercial real estate. We'll come back to that, commercial real estate debt. This looks like what the middle market lending slide probably looked like if I was on this panel, 7 years ago. I find this actually funny. It's almost like cocktail party conversation. Look in 2007, the top 15 lenders with all the red X's through them, and look at the market today. And for the first time ever, there's Cantor Real Estate, there's Ladder Financial.
For someone that can't read it, what does the red X's stand for?
So 2007, that is the league table of the top 15 CMBS commercial real estate lenders. The red lines, I can't read them either from here. But
the red
lines are the firms that no longer exist.
Well, I think that was the point I wanted to emphasize for everyone.
Again, this is a market setting up lots of supply, limited demand, ability to, control your terms. Again, the opposite of the liquid market.
Just really quick.
Last one I'll mention, I think running a strategy where you have a short side, the ability to go the other way in the market is something that we focus on through our hedge fund. But lastly, and maybe this is a topic that will get others in the group going, is the opportunity in Europe. So as you saw in some of these slides, there is, again, maybe 7 years ago in the US, maybe this is what the US looked more resembled, where you have a market that's largely dominating in the lending space by banks. And it seems to us, both pulling assets off banks, lending directly to companies or sponsor deals, there seems like a big opportunity to create really good supply in a market where the banks are only going to shrink.
I think a couple points here, Dave. I'm going to go to Michael and then I'll go to you. I think it's very important we understand this evolution over the last 40 or 50 years. If we pulled up slide, say, 54, the opening of financial markets in the United States where most of your job creation is in small and medium companies. As capital was provided, as the public and private markets, things underwritten by banks, etc. But the shifting of the ownership into, quote, the high yield market, you had this enormous change with 62 million jobs being created in the private sector and -4 by the large companies. And there's many issues there. One, companies that had the only access to capital, those 500 or so investment grade companies, were now under competition for new and other companies that had access to capital. And you can see it kind of began in '74, but it was fully opened by the early 1980s. Things went in opposite directions. Now, if we go back and look at '54, you'll see here that the US had a substantially different history than Western Europe. But the financial technology that existed in the United States is now well understood. Every single one of the panelists up here is an investor in Europe, not just the United States. And the ability to create jobs in Europe by funding middle-sized companies today can have a real positive effect potentially on new industries, new businesses. And as Michael suggested, not just in Europe, but in Asia and Latin America and other parts of the world. And so we've had a significant advantage here. And as was pointed out, we're talking tens of thousands of investors that understand credit. You can imagine my excitement where everyone was focused on 500 companies and we had the other 4 million to finance. You know, today that isn't an opportunity because it's widely understood. Michael, let's talk about your firm today and what your firm might look like 3 or 5 years from now.
Certainly. I mean, just let's pick up that covenant-lite point which we had and lead into there. I mean, the interesting thing about that is the market, the market when you had covenants was self-correcting. Frankly, you could buy an index and you'd know what would happen. Nowadays, you have to work very, very hard. Your fundamental work has got to be much more sharp and much clearer, and you have to be much more active in your management. Because the reality is that if you aren't nimble, you will get taken to the cleaners.
Let me underline that point for you that Michael has made. Almost all your investment grade debt had no covenants. And the LBOs of '05, '06, and '07, because they didn't have covenants, piled debt on top of that investment grade debt. And now it was at the bottom of the capital structure.
That's exactly the point. And you know, if I might just turn to slide 29 for a second, you can see when you look at an index, there is a significant dispersion around that index. It shows how things have moved over time. But the point is that it's all very well to talk about indices, but in terms of asset allocation, but the reality is you have to do the fundamental homework, name by name, maturity by maturity, and country by country. I mean, and the geopolitical stuff, which we haven't talked about here, that context is also pretty exciting and it gives enormous opportunity. But if I might move on to where is the firm going? Where is my team going? The reality is we are going to that bespoke alpha point which I talked about. We are going to have to be much more active and much more nimble about where it is. We are looking away from the large financial buyers, and our view is if we really want to get the value, we do have to go away from the crowd. Frankly, at the moment, I'm quite. I believe there's a significant amount of risk in the government market. I mean, if you've got a 10-year Bund trading at minus 10 basis points or minus 5 basis points, for goodness sake, Spain in that maturity is trading at minus 5 to 10 basis points. I mean, the reality is, you think what that does to your duration. I mean, it takes the duration further than your maturity. I mean, it's not a happy day, right? So you've got to be very thoughtful about that. You have to be. So we're working more in the loan market. We're working with companies that can actually will allow us to give them guidance in terms of where various structures are. We are going down that route. And again, the team is working again with clients, aligning aligning fee structures, aligning maturity structures and risk structures to get that to go. You know, that's our beast.
So let's go just a one-sentence answer, David. Would you say you're a fundamental investor, bottom-up credit work, or you're looking at macro?
Very micro, bottoms-up, fundamental.
Steve?
You have to be micro bottom up, but you have to be aware of the macro environment. So, you know, I'd say that our special sauce is our fundamental, but we have to be aware about the environment and the timing.
So what you're saying is you're doing fundamental research on markets, et cetera, but your investment decision itself is micro.
Yes.
Rich?
Exact same answer. It's all based on fundamental roll-up-your-sleeves work. I mean, credit is credit. I mean, it's the exact opposite of how you want to think about an investment return potential. I mean, you have 5-10 points of upside, and you have, you know, theoretically 100 points of downside. It's looking at what could go wrong, but I absolutely agree with Steve. You don't want to fight the tape either. The technicals really do matter.
Tom?
You can't quant credit. We're fundamental bottoms up. We've invested heavily in research teams across the world and in the markets where we invest. And there's no sub for fundamental analysis.
Michael?
Yeah, detailed fundamental work undoubtedly. But the one thing which we also spend a lot of time on is the geopolitical, especially when you're getting out of the US. The reality is you've got Brazil versus something like a Petrobras. There's a significant number of ways in which you need to think about the country risk across the world to get value. And frankly, if you've got some of the Russian banks, you can hedge that with Russian CDS, and frankly have a pretty sensible pickup because the political risk is significant.
David?
Yeah, so when I want to talk a little bit about the future, the present and the future. So when Rich was talking about middle market.
By the way, what does DW stand for in your firm? Okay, just checking.
The thing that we're already seeing happening, and I think it's going to happen much more, is if we can attract flexible capital, as we start to get into these direct lending businesses, we can deal with the entire life cycle of a company or situation. So for example, in the CMBS that I talked about before, we're already using our fair value option to buy loans out of the pool, negotiate directly with these borrowers, in some cases have the foreclosure threat or sometimes foreclose on the property or provide some additional capital to the borrower to get him back on his feet. I think the same thing is going to happen to firms like ours as we attract capital for middle market lending, and then you can make 6-7% returns or 5-6-7 over the LIBOR in normal times. But when that borrower gets into trouble, we can also provide the rescue financing. We can also provide the equity capital to get them back. This is something that's very different and new. And so if you ask me 5 years from now, I think funds like ours will be doing a lot more of that. And I think it's very exciting for investors to be able to have that type of capital.
So let me ask a quick question to the panelists, starting with you, Rich. When you're investing in corporate credit, how important is management in your decision to invest?
It's critically important, Mike. Management, I mean, look, this is fundamental research 101. Again, a lot more downside than upside. I think, you know, a credit investor, I always kid with our equity friends and colleagues. You know, I always say an equity investor, all you have to do is either like a stock or you don't like a stock. For a credit, you know, we're not looking at hockey stick projections for the most part. We're not looking at multiple enhancements. We're really looking at what could go wrong and management, right capital structure, come back to covenants. I'll say covenants 3 times, covenants, 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 and your ability to protect your rights when equity interests misalign with creditor interest, and the ability to actually do something about it before, or the smoke detector analogy. You want to before there's an out-and-out fire, you want to be able to protect your rights. So it's everything. It's being a fundamental, private equity style due diligence investor on top of all the nuances of the credit business.
And so let me just paraphrase a message that Rich has delivered, and that is one of the best ways to make money is not lose money from that standpoint.
Yeah.
Tom?
No, I agree. Management is always a key component of the analysis. And we were talking earlier about the covenant-lite being over 60% of the market, and maybe 9 out of 10 deals oversubscribing. We've still, over the years, have probably averaged around a 50% hit rate on approval declines. And I would say a lot of times it comes down to, do you feel like this management team can execute the plan they're laying in front of you, because you are leveraging them up to do something. And you may argue economics, you may argue just the structure of the deal and the pricing, but sometimes it just comes down to, can they pay you back?
All right, our last topic today I want to touch on is pension funds. So most of the pension funds, or the promises and the commitments, people used to have actual assumptions of 9, 8.5, 8, 7.5, 7. They're adjusting them today. The credit markets don't really. You can't go out and buy credit, traditional, off-the-shelf instruments, even single Bs today, to meet those levels. So let's go across here. David, if I'm a pension fund and I tell you I have a 7% actual assumption and I want you managing my money, what are you going to tell me?
Yeah, I'm going to tell them, first of all, they should have, they have long duration liabilities. They should have equities as a huge component of their portfolio. But for the credit, I would suggest you can achieve these types of 7% returns. You have to be willing to take a little bit of illiquidity. You have to be willing to take a little bit of complexity. You have to find the right managers. But it can be done. And it can be done with lower volatility than the equity markets.
On the endowments I'm on, just focusing on the fixed income part, I say it's like a 3-minute mile. You're not going to get, so you have to reallocate to higher expected return asset classes, or lower your assumptions for that percentage. That's the credit side. I think probably in high yield, probably 4 to 5% is a generous to fair assumption for the next 5 years.
All right, and I think one of the things that we talk about in our financing cube, which we'll address in another panel on capital structure, is really the underpinning of financial markets starts with credit. And I think one of the things, Steve, that if I was to paraphrase you, by having strong credit, it gives you a really good look at what equities to invest in. Michael, they're walking in the door. They've told you this is their actual assumption. Those are the interest rates for triples to Bs to AAAs. What are you going to tell them?
Well, I'll tell them at one level, good luck, guys. I mean, but the point is...
But they're coming to you. They want to give you money.
No, and the reality is, if they want to take the risk, they want to take the maturity, they want to take the liquidity, we can get there. But the reason why I'm really worried about this thing, we've got a global GDP of, 80, 85 trillion. We've got an investable universe potentially, if you look at the McKinsey numbers, of 200 to 250 trillion. Take 5% of that, you've got $10 trillion. You've got $80 trillion every year turnover. You just can't square that circle. I mean, I can help with 5, 10, maybe even 100 billion, but I mean, I can't help them with the 250 trillion that's out there that needs to be invested.
Are you telling us you're limiting your firm at 100 billion?
I
just wanted to check.
No, I'm not.
So they better get in quick,
no,
right?
But again, it's those returns, they're not available on 250 trillion. Yeah.
No, I do think that you're going to have to take more specific strategies. When David talked about legacy structured products, you probably can get those types of return with legacy structured products as a subset, for instance. So you have to get more particular idiosyncratic opposed to index-based if you want those types of returns.
Tom, you're running what, 220, 250?
215.
I mean, can you get actual assumptions to 7?
You can't solve it with one asset class. It's really, I think, about the portfolio management and where does the fixed income, where does private credit, real estate, and equities and alts play, and what's the right mix. I think the key is, one, we're going to see a lot of institutional investors work with fewer managers that can take them across asset classes and find that relative value, whether it's credit or real estate or other asset classes, faster. And I think at the end of the day, you have to take a long view. You cannot solve some of these underfunded issues in a short time frame. You got to look over a longer period.
Rich?
Mike, I'll sum this up pretty briefly. I think we can hit bogeys like on that screen. Again, I agree, it's maybe less liquid, skewing the odds a little in your favor on supply and demand and looking at products. We gave some good examples. But bottom line, we've even seen assumptions on pension plans and others even a lot higher than that high sevens number. And the reality is, I say 5 is the new 10. The sooner you get used to accepting that 5 is the new 10, then you're not going to go out searching for yield in all the wrong places, which we know how that movie ends when the music stops. Not too well.
Well, I want to thank the panelists for joining us today. Just a couple observations. It is a market of stocks, not a stock market. Every day, companies make new highs and other companies make new lows. It is a bond market of individual companies, not a bond market, in that there's some companies that are improving credits and some that are deteriorating. And I think what we hope to discuss today is that investing in credit is a serious business that requires both a macro understanding, but really a micro effort to understand individual credits. I want to thank you for joining us today, and have a great day.
Good.